Hey guys, okay, the biggest question when it comes to choosing which type of entity. So generally if you get here, you've decided, you understand that you need some sort of entity. You shouldn't be operating as a sole proprietor or even much worse, just a general partnership, which are the default classifications that you will receive from the state government, guaranteed, no way around it if you do not form an entity. So a sole proprietor is just you're in business for yourself, you don't have any business partners, and you're going to be personally liable for anything that happens in the course of your business because you don't really have a business, just you. LLC prevents that, of course, and I'll talk about how S Corp prevents that as well. But a partnership is when you're working with one other person or multiple people in your business and you have not formed any entity with the state, then you will have a default classification as a partnership, meaning you could be personally liable for the acts of your business partners. Now, whether this doesn't mean that you have to have some contract stating that you're business partners. If the state looks at what you're doing and determines that you're kind of in business together and you haven't filed anything with the state, you will be personally liable. Like, you could lose all of your savings, your house, everything else for the acts, torts of someone else that you work with just on a daily basis. It's just mind-boggling that people let that slip. So, but the bigger question is LLCs versus S Corps. I'm going to try to keep this really super duper simple. I'm not a CPA. I'm not a tax attorney. I defer every time somebody asks me something about taxes, unless it's just super broad. I generally defer that to a CPA because I hate it when CPAs give legal liability advice. So I'd be a huge hypocrite to just start handing out and doling out tax advice because that's not really my expertise. But here's how it works. An LLC is something that gets filed with the state. This is your business. You file this at the state level. This is where it gets like really confusing for people because they think that an LLC is something that's different than an S Corp. An S Corp is not any different than an LLC in most cases. So LLC is at the state level. At the state level, you can be a sole proprietor by default, meaning you file nothing. You can have a partnership. You can have an LLC. You can have a corporation, or you can have like a nonprofit as well. Those are kind of the ways that you can structure your business. So you can have a corporation at the state level as well, but there's really no reason to do that. That's only kind of a holdover from back before the LLC was created. I think it was created in the early 1980s. So those corporations are still around, but there's really, in this business, no reason to use a corporation at the state level now. So you file an LLC with the state. Then you will apply with the IRS. Here's the IRS. It goes like this. So you form your LLC. It gets approved by the state. You go to the IRS to get your EIN, and there you will be asked how you want your LLC to be taxed. So this is where it gets tricky. So here is the different ways you can be taxed in an LLC. An LLC has something called pass-through taxation. Pass-through meaning you don't pay taxes at the LLC. Generally, the default that the IRS will give you is that you have pass-through taxation, meaning you don't get double taxed like you would in a corporation that you have at the state level. So you pay no taxes for your LLC. You just pay taxes through your personal tax return on the profits that you make in your business. That's the default of an LLC. That's how most LLCs operate, and that's how most LLCs should operate because S Corps are more complicated, and we'll talk about that. So LLCs have pass-through taxation. S Corps also have pass-through taxation. So the big thing that the reason why you might not want to take the default classification of LLC being taxed as a disregarded entity, meaning it won't get taxed by the IRS, it's disregarded by the IRS as a company, and it's just you still have the state level protections, but the IRS just taxes you as if there's no business there, it's just you. Now, that can be confusing to people because you think, well, I have an LLC, shouldn't I be taxed as an LLC with the IRS? But it's not necessary. The IRS doesn't determine what type of legal liability you take on in your business. The state does. So that's the big distinction that you need to understand. LLC is at the state level. IRS is the federal level. And this is where you can take an S Corp election. So it will ask you how you want to be taxed. You can choose when you're getting your EIN from the IRS. They give you an EIN. It's a quick and easy form that you fill out to get your tax number that you'll give to the bank that you'll use to pay your taxes, essentially, that you'll just use for your entity. If you choose to be taxed, you can choose to be taxed as a C Corp or an S Corp, even if you have an LLC. So that's why the LLC is kind of so dynamic. It can work on so many different levels. And I'm trying to keep this super simple. The reason you would do an S Corp is because you could take your profits, you could basically become an employee of your LLC, but you're taxed as an S Corp. So you're an employee, you take a salary, you take what the IRS calls a reasonable salary, and that's the only guidance you get, is that it has to be reasonable. So it's reasonable given that industry that you're in. So if you're the CEO of a real estate investment firm, you're probably gonna have to make, I don't know, 70, 80 grand. I have no idea what the actual number would be. A CPA that works with real estate investors would probably be able to tell you if it's worth it for you to do the S Corp. The reason you would do that is because on your salary, you're going to, with an S Corp, you will pay, the normal the same level of tax that you would on a pass-through entity, meaning you're going to basically pay the equivalent of the self-employment tax, which has the Medicare and Social Security tax included. How can I make this even more simple than that? So then, say your company makes $150,000 profit for the year. You've designated to yourself and to the IRS and through your operating agreement that you're going to take a salary of $80,000. So that leaves $70,000 of distributions that can come to you from the S Corp, not through salary, but through dividends. When you're like paying out the profits of a business and your tax as an S Corp, that's how you do it. And you can avoid about 15% of taxes roughly. I think you can get that extra profit taxed 15% less. So there can be significant savings if you have a large profit. The problem is that most companies starting off, they may make a profit of say $30,000. They try to pay themselves a salary of $10,000 and then give themselves the lower tax, the lower taxable profit of $20,000. They try to get that, they pay themselves a salary of $10,000. They then give themselves $20,000 of dividends and try to get that at the lower taxed rate. The IRS is not having that. And you can lose all your protections from your LLC completely if you don't do all this exactly right. So that's why I generally don't suggest S Corps for most businesses unless you have a CPA that's literally like working with you hand in hand, and possibly an attorney too, because you have to know. A lot of CPAs don't even understand this, to be honest with you. They'll create a corporation at the state level and then elect to be taxed as an S Corp. It just doesn't, there's no need for that. It just doesn't, you shouldn't have to do it. You're just putting unnecessary regulations on yourself. So the S Corp, LLC has pass-through taxation. You just set up your LLC and just operate your business. And you may pay potentially 15% more on taxes at the end of the year than you would if you elected for S Corp. But that's only if you can get a reasonable salary. You're not gonna be able to take $10,000 in salary. They're gonna make you take, 70 or 80. And then most of the time, you're not even gonna have any profit left over. So you're just gonna have to pay the regular old tax here. There's no profit left over to give yourself dividends on the back end that are taxed at a lower 15% rate. It's just, most companies don't operate that way. So when you become a little more sophisticated and you're earning a lot more money, and you want to take on, you're so much money's coming through your business that you want to take on actually hiring a CPA or a CFO for your company, a chief financial officer for your company, then this S Corp status makes more sense. It makes a lot of sense when you start having a really sophisticated business. But for most of you, LLC, straight up. I hope that answers all your questions. Feel free to follow up. I'm hoping that just seeing a little bit of it visually and understanding that an LLC and an S Corp are essentially the same thing. It's just how you elect to have your LLC taxed at the federal level. So LLC is at the state level, S Corp's at the federal level. You can have an LLC that is an S Corp. You can start off your LLC. I know this question is going to be asked. You can start your LLC and just have the general pass-through taxation, and then later take an S Corp election and change that when your business becomes more sophisticated. And that's probably where most of you want to start. But talk to your CPAs about how much money you're making and whether or not you can save that 15%. If you don't have a CPA, I suggest don't even look at the S Corp. Also, if you're not if you have a business partner that's not a citizen of the United States, you cannot be an S Corp. S Corps can only have U.S. citizens as members. So that's another thing to keep in mind. Only U.S. citizens and S Corps. I don't know why they do that, but that's just the rule at the IRS level. So thanks, guys. Keep asking questions.